Welcome back. Here with Money, Money, Money. This is the festive series, and this week is all about the property market special. Is property really worth your time, your investment, and your money? Well, our guests here have already given out the golden rules in terms of the return that you should make if you're going to invest. So then, Ghulam, is there anything like that in the market right now, anywhere in the country?
Well, it's very difficult to highlight or locate such thing which in future will develop in terms of next 4 to 5 years. If I go by his 15% logic, it has to develop in 4 years and not 5. So, this kind of property is very tough to find, because typically these appreciations happen only when, either the economic drivers suddenly fall into place for a location, or infrastructure suddenly improves in next couple of years, etc. Like, for example, if this metro that we're talking about, metro number 9 and 10 in Mumbai, has to fall in place, suddenly a few locations like Dahisar or Mira Road, etc. will find favors all of a sudden. Similarly, the coastal road for Mumbai that we're talking about, or the connect in Delhi, NCR that we're talking about, when these things, or even metros that are taking shape in Delhi, when there is something like this happening up, then there is above normal increase in property rates which are actually connected to these locations. But then once again, while I am taking that argument, it's also equally risky to go completely by that, because we haven't seen any project actually completing in the timeline that was given to us.
Since you're talking about projects that are coming up, it just reminded me of the hallowed Navi Mumbai airport. We saw the boom, we saw the bust in properties surrounding that. What's happening in that micro market?
Actually, 2 booms and busts have passed by and the airport is yet to be complete. So that's the exact point I'm making, that if you are caught up in a situation like that, where you actually put all your money because of a piece of infrastructure has to fall in place, and if it doesn't have to in that time frame, then perhaps all your money would have gone down the drain. You would be better off investing in some other asset class and make much better returns than putting up money in this.
Okay, so if you were to, really try, I understand the caveats that you're putting in, but if you were to play some theme based on an infrastructure coming up in the surrounding area, and therefore you're banking on, let's say, the next 5 to 7 years, let's stretch the time horizon, then what sort of areas or markets or project zones come to mind?
See, first of all, the locations where real estate prices go better than the rest of the country are only Mumbai to begin with, and to a certain extent Delhi. Then I can't even think of Bengaluru, because your average increases per year is still in the 5-6% range,
which doesn't meet his benchmark.
Doesn't make sense. And nowhere else in the country would you see that kind of price growth except for Mumbai and Delhi to a certain extent. And in these two locations, in these two cities or agglomerations, I would say, talk about western suburbs where the coastal road is shaping up, and I hope and want to see that happening in next 2-3 years. A few locations which will be connected, whether it is Malwani or beyond that, is one of my favorite choice to make. Or if I go on the other side to Gurgaon, Neemrana. Neemrana is emerging as a huge industrial destination with so much of Japanese investment already gone into it and shaping up as an investment zone on Delhi-Mumbai Industrial Corridor. So the stretch, which is the new Sona and etc., are looking very promising to me.
Because is that market already overheated? Because we've already seen a significant appreciation, or is there still some headroom?
See, number one, it is definitely overheated. But then last, as I said, a quarter or so, we have seen prices melting down. So if it is 20% lesser than what it was, say, 6 months back, I would still look at it favorably, because to me, some more of correction can give me a good entry point. And then wait for the entire Sona region to develop and the whole Neemrana industrial belt to shape up, and I would definitely make good money there.
Okay, I also want to talk about Tier 1 versus Tier 2. I'll come back to that in just a bit. But Karthik, what do you tell clients and associates who come forward wanting to make an investment? How do you even start? I mean, how do you do your basic cash flow, the allocation, and also how do you identify how much is it that you can afford? We're not talking about a house where you want to stay. Now we're talking about a property which is pure investment.
So the first thing that I want to look at is the overall net worth position. The reason we don't allow or we don't advise an overexposure to property is because at some point of time, if you need money or if you want to liquidate something, it's really tough. So the rule of thumb that I like to follow and I like to advise is try and have a rule of 2:1. So for every 1 rupee that you want to have in real estate, you should have 2 rupees outside real estate into anything you like. It could be mutual funds, could be fixed deposits, it could be gold,
liquid
but it has to be some sort of a tangible liquid asset where you can actually withdraw the money. So that's your first rule. The second rule comes for your installments. Now, if you're going to buy this on a funding, then it should be in such a manner that, you're not spending more than 25 or 30% of your net inflows after tax. The basic third rule is that no matter what you do, you should be able to put away at least about 20 or 30% of your net cash inflow into an investment, which is a liquid investment. So say if you had a very, very ballpark sort of a division, 1/3 of your money should be invested, 1/3 of your money is your expenditure budget, and only then you can afford to put in 1/3 of your money into an EMI, if you like.
If you're buying property from borrowed funds.
Correct, absolutely.
Okay.
Now, here's another dimension. A lot of times we also advise that when you have some surplus money, or when we've made significant capital gains in other markets, and you want to try and get a little real estate into your portfolio, then do it in a leveraged manner. Meaning, if you can actually afford a cash flow, even if you don't need a loan, you maybe take a loan. And then what happens is you invest the larger part of your money, give the 20% down payment, assuming you can afford the 80% installment-based payments. Your 80% invested grows at a much faster rate, and at some point of time you start making prepayments to that loan, and effectively in about 10-12 years you pay yourself or reimburse yourself back not only the cost of the property but also all the interest, and that becomes a very smart purchase.
That's always been a big debate. If I can afford to buy a house without taking a loan, should I actually go ahead and do it or not? Because then the tax calculations come into play. And let's talk about someone who's in a 30% tax bracket. Are you in favor of taking a loan even when your cash flows allow you to buy the property straight up?
Yes, Surabhi, it's very interesting. The reason it is interesting because, one, you get tax benefits for payment of interest and things like that, because it will become a deemed let-out property, even if it's even not actually let out. So you get larger advantages. If you don't take that advantage, you still have the Section 24 interest payment advantage that you can make use of. Okay, that's to start with. The other very interesting thing is, in our market today, home loans are available at the rate of approximately between 9.25 to 9.75 as a broad range. Versus that, if you invest in assets such as equity mutual funds, of course, we're talking about a substantial period of 5 to 10 years and things like that. So there, if you're actually making 14%, 15%, 16% tax-free returns, and your property itself is also assumed to appreciate at least minimum 12 to 15%, then the cost of that loan is quite negligible. The greatest assumption here is that you can afford to pay that cash flow in the interim while your 80% asset is growing. So once your asset grows, you make tax-free money there, make the prepayment, your property becomes free. It's a very interesting way of looking at how to buy a property.
Okay, now that we have all the basic rules in place for buying property, the question is, which markets do you look at? We've already discussed areas where infrastructure projects are coming up. But what about tier 2 cities? Should you be considering them? Should you be thinking residential? Should you be thinking commercial? All those questions answered after the break.